think silver could easily be trading at $30, $35 an ounce next year. I think that's also, if on the back of a gold market going to those levels I just said, I think, yeah, silver could be there as well. But really what attracted me to the exploration stage is that majority of the billionaires in this industry made their money in exploration. They found new discoveries. And today, those business models they're looking for those discoveries today are historically cheap because of a gold market that is just out of favor. And so to me, that's really where the opportunity lies ahead.
Switch towards a life of financial freedom. The Load Wallet helps you make the right switch by giving you access to a more reliable, inflation-resistant money you can trust. Money backed by silver and gold that empowers your businesses to eliminate expensive fees and settle payments instantly, and preserves your wealth for generations to come. Take back control. Download the Load Wallet today and begin building your honest money portfolio.
Hey everybody, this is Rob Kientz, and we're back with Inside the Markets, and we have a very special guest, Tavi Costa with Crescat Capital. You've seen him at our conferences. Of course, he hits conferences all around the world. He does great research on macroeconomics, the metals industry, mining, and lots of other things. And I think this is going to be an absolutely great interview. Tavi, how are you doing today?
I'm great, Rob. Thanks for having me again. Looking forward to this.
Yeah, absolutely. You've been such a great wealth of information. Anybody who wants to know what's going on in the economy basically can do a couple of things. They can follow your Twitter or your LinkedIn feeds. But how else do they get a hold of your research if they're interested? Do you have some sort of report that you guys do?
I do reports, not necessarily have like a time frame that I put out, but I usually work on research letters that I put out every couple months. And I have one that is going to be coming out soon, hopefully, for people that are interested in precious metals. I think will be a particular report that will be very in depth about our views in the gold and silver space. And so you can find that in our website, Crescat.net. And you go to investor letters and you can find most of our letters there. I'll probably post on Twitter as well.
Okay, fantastic. So we'll get into mining and gold and silver here in just a moment. I want to concentrate a lot on that. But before we get started, I have a few other questions for you. Namely, basically, I'm always interested in how people got involved in this sector. Everybody, I think, knows my story. What was your story? What really got you interested in commodities of gold and silver? And why are you here today versus doing something else?
Well, it's a lot of reasons, I guess, but it was a learning curve for me as well. And it started back in 2018 when I would say we've had a lot of interest at looking at the yield curve inversion problem that was occurring at that time. And I've done a lot of work on what were the best performers in terms of asset classes and just assets in general that perform well when you have the levels of inversions that we had at that time. And which in fact we have the same today. But at that time, what we found was that buying gold and selling stocks was perhaps the best ratio that performs well for the next 2 years once you reach a certain level of inversions in the yield curve. And so that research led me to understand better the precious metals space. I started really becoming more bullish on gold from a macro perspective. Then I realized I've always knew about the sort of gold bug, more thesis behind the gold space, but I wanted to really refresh the whole thesis and with new lenses of my macro perspective on what was likely to drive gold prices much higher. Then started looking at the miners. I stumbled onto a chart of the CapEx, the declining in CapEx for commodities in general, which started really with the miners. And then I saw for the overall commodities. And that just immediately made me very, very bullish on commodities because that made a ton of sense. Then I started researching the 70s and also the early 2000s and saw when the commodities to equity ratio was at a significant or a historical depressed level, you want to be allocating capital towards that. Then start learning about the potential secular shifts in terms of inflation, And then when, and so that learning curve began to really steepen. And when I saw that the major companies also had a supply cliff issue was when we started talking to Quentin Henney and to really go even in a more elaborate way to invest in exploration companies given that view. So that's kind of how I got into this. I mean, I'm still a macro analyst, and that's how we manage our portfolios is through a macro analysis. But that's sort of my involvement in this space has been, not an accident, but really because of forming views over time about this industry as a whole.
Well, Crescat is such a great resource for people to learn about the sector. So I definitely appreciate you guys. I use your research all the time. And I wanted to look at some of the research you've been put out recently, especially with regards to inflation, because we've had this big debate, Tavi, about the Fed and interest rates and inflation versus deflation and what we're seeing in the economy. And that's all been complicated by the shutdowns through the pandemic and things like that. And it seems as though there are some parallels to what we've seen in the past and maybe not so many parallels, but one of the things that tends to repeat, I guess, or rhyme throughout history is inflation. So I wanted to share a chart that you had put out over social media. And it's really talking about that inflation comes in waves. And so you have some inflation, then you have some deflation. And I also notice here that by the time you get to the second or third wave, you're increasing inflation. So according to your chart, we've kind of gone through the first wave and we're retreating a little bit. And then maybe we'll go through our second and third. Do you see like this, what we saw in the 70s, do you see that also playing out now? Or do you think the situation is different for any reason and it may look a little bit different than this?
The short answer is yes. And unfortunately, I didn't have enough characters to really elaborate on Twitter on why, I think this is where we are. But there's a lot of reasons of what's going on. Number one, it has to do with look, inflation, it does develop through waves because it usually impacts consumer behavior over time. And so as that changes, you usually see even businesses changing the way they behave, and therefore that builds on its own over time. So that's the first thing to get out of it. The second thing I think it's important is we've had a couple of years in the last, I would say in the last 2 to 3 decades of cyclical inflation that was, I think a lot of folks are confusing with today's environment. I don't think this is very cyclical. I think the nature of this is actually very secular, and it's caused by what I call the pillars of inflation. We have the wages and salaries growth. We have the shortage of commodities. We also have this reckless amount of fiscal spending. And the fourth one is really this deglobalized world that we're entering right now, which is very, very different than what we saw back in the 40s, which was also an inflationary decade that a lot of people like to compare with. And today is quite opposite. So those are problems that are not being solved by, number one, by recession, and also are being actually exacerbated by the tightening of monetary conditions, which makes me believe that if there is a deceleration of growth and demand is hurt, and also you see inflationary forces decelerating, which is what I suggest in that chart, that we're at the beginning of the end of that first wave of inflation, that those issues are never going to get resolved here in the short term because they have never been resolved. And so we're probably going to see, an emergence of that wave, which is going to be the second wave, and likely would be, I think we're going to see double digits growth of inflation in this decade. And so I feel strongly about that, especially because the prior peak was very close to a double digits right now. And so I think that if we're going to make new highs, it makes me immediately believe that we're probably going to go to double digits. And, ultimately, we face the trifecta of macro imbalances that I talk about so much. It's the debt problem of the 40s, the inflation problem of the 70s, and also the valuation problem of the late 90s. And all those are the ones that create, I think, the real political constraints that will prevent policymakers to really fight inflation over time. And that's what's going to happen. It's going to probably build on itself over time. And it's a problem we're going to have to deal with for the next decade or so. And a lot of people will mistakenly think inflation is over when we see this deceleration. And that's the time what you want to be taking the opposite bet on markets in general.
I agree with you. And I love the fact that you brought forward that there are things that we've seen in the past. This time we're maybe seeing multiple different scenarios playing out at once. And you mentioned different time periods. I would add into that also a currency crisis, because I think we're de-dollarizing. You've got the BRICS setting up their own competing currency as well. So the dollar itself is going to come under pressure. So you're going to have a currency crisis, I think, is to add into that. Given all of those factors, Tavi, how do you feel about what the oncoming recession is going to look like? Is it going to look like 2008? Is it going to look like the 30s? What do you expect that we'll see?
I think the steepness of the recession itself will depend on how the Fed will react, and also will depend on how inflation behaves over time. I think we're entering a recession and a contraction, and that means that valuations where they are for risky assets, particularly financial assets in general, and stocks, to be even more specific, are out of line with the fundamental contraction that is likely to happen in the first and second quarter of the next year. And so, to me, as a money manager, that's what matters the most. Now, the reaction towards that is what I'm referring to, the question of what's going to be the severity of this recession that I believe it's coming. And if inflation actually bottoms before a lot of people think, so let's say inflation bottoms in 4% rather than below 2% of the target of the Federal Reserve, or so forth, then the Fed is going to be forced to continue to tighten even further, or actually not release liquidity as a lot of folks are betting on. I mean, if you look at the curve for interest rates, it's already expecting that the Fed is going to actually be cutting interest rates not too long from now. And so if you think about that, if that actually ends up not being true in the short term or medium term, then I think that could actually cause a big shock in markets in general. And one thing is when you take interest rates from 0 to 4%. The other thing is when you go from 4 to 6% or so. I mean, that range of 4 to 6% and even beyond that is really where you start seeing, the people that are swimming naked is starting to show some issues. The frauds start to appear. You start seeing some real collapses in equity prices, and even other issues with private equity as well. And so we're not, we're starting that kind of phase right now of the recession that I think it's the where you really see bad news becoming bad news for the markets in the way they behave. And we haven't seen much of that yet. And the consumer is getting squeezed. We know that, and the types of signals that we're seeing in the macro side, when you look at the yield curve inversions, for instance, and the levels of yield curve inversions that we're seeing, is again signaling buy gold, sell stocks. That's very clear. One more time, and since the 70s, that is the one trade that worked very, very well for the next 2 years. And sometimes it's due to gold prices moving higher faster than S&P. Some others is caused by the S&P collapsing and gold holding its ground better than the S&P. And some other times is a separation of the two, where gold works, meaning it goes up in value, where you see the S&P 500 actually declining in value over time. And that is what we saw in 73, 74, and also in the tech bust, which I think are very similar scenarios to now as far as how this could unfold. And so that makes me, when I look at the NASDAQ already down 30%, it doesn't make me less bearish necessarily, but makes me, initiating today this signal of buying gold, selling stocks, it makes me extremely bullish on gold right now. So that is why I am, that signal to me is religiously the time when you want to be allocating capital in the space more and more.
Yeah, and it's a good point that you made about the gold and the time to get into it, and we'll get into that more in a moment. I wanted to go to energy and deflation, so we're going to do another chart that you talked about. It looks like energy prices, or at least oil prices, have been coming down. What do we draw from this chart here? Do you think that we're going to pass through support, or how do you think the oil prices are going to react to what's going on in the global economy?
Well, to start with is the sentiment, right? When oil was at over $110 a barrel, or so $120 a barrel, there was no shortage of people calling for oil going to $300, $400 a barrel and so forth.
Mm-hmm.
And now that the oil is back to $70 a barrel, no one wants to touch it. And everyone's saying it's going to go back to 40 and 50 and 60 and so forth. It's not my view. I think there's a floor for oil prices given the fact that supply does remain very constrained, and we're not seeing production of oil really increase. And if anything, all we're seeing is the unleashing of further geopolitical problems that can cause, a bigger issue that can be the driver for oil over time. And so I remain very bullish in energy. I follow closely what's happening with the CapEx situation. I follow closely what's happening with even the ESG mandates of institutional capital actually not chasing oil in general. And perversely, that actually has helped the industry that had two back-to-back incredible years. And I was a little concerned about this in the last months, because when you have two back-to-back incredible years, usually it's hard to have a third one. So we have been shrinking our exposure in the last months, believe it or not, in energy. And now we've been increasing it again, because I think this sell-off is again a gift. And so we've been increasing it one more time, and hopefully, that's going to be it. But look, I think also on top of this, and I found by most of the views that we have is the foundation of this whole thesis is on the CapEx situation that continues to be very depressed historically. And I don't think that has really changed to create the abundancy of oil in general, but also natural resources as a whole. And so when I have a commodity that falls as much as oil has done recently, certainly creates an opportunity. And it's one reason why I think, you look at overall commodities, they all look attractive. All of them look very attractive, but maybe with lithium being in one of them that I'm not really involved. But if you look at all of them today, oil, energy, agricultural commodities actually led the way since 2020s. And now finally, I think we're going to see precious metals leading the way, especially after this macro signal of the yield curve inversion. So while I like oil at this price is at $70 a barrel, and we've been adding, I think, the basket of commodities right now needs to be larger on precious metals.
Yeah, I agree with you. And I want to get in the mining space and the equity space, because what I see here is historic levels of undervaluation with regards to where the metals have actually been. So I think the bullion, going back to your earlier point, has held up very well this year. It's sold off less than a lot of the stock investments. And I think silver is almost break even given, a little bit of fade in the price today. So the metals have done fine. And we talk about those all the time, but a lot of people aren't really talking about the miners. They're not in the scope of people's radar. People aren't looking at them. The generalists are kind of looking at the indexes, but I don't think they've really moved into it yet. And this may be, a good value investment for people in the market. So we're going to put up a chart that you have here. And this has to do with what the miners have been doing. They've been paying off debt and deleveraging and getting their balance sheets in order. Can you kind of explain why this is important for people looking to invest in the space?
Well, the cyclicality of the fundamentals of the mining industry are perhaps the most important way of understanding the mining cycle as a whole. And so that means when you're seeing this period of conservatism, like we're seeing in general by management teams in the mining industry, is something to take note. And usually that is aligned with being at the early stages of a bigger trend. And certainly, we've been through the last decades of not only issuing a lot of debt, but even issuing a lot of equity. And now we've had a 7-year period of deleveraging. So balance sheets are getting healthier. And on top of it, we're seeing buybacks of companies actually buying back their stocks at very cheap valuations. And while you think about this in a more positive way, because they're doing everything they can to attract institutional capital over time by creating those, shareholder-friendly policies, you also have to consider the fact that they are doing more buybacks and dividends than what they do on CapEx, which means they're investing more. They're actually returning more capital to shareholders than what they actually invest in their own businesses. That's a huge deal. If you look at the cash flow trend, for instance, just look at cash flow in aggregate over time, and you take the percentage of cash flow that is actually going to CapEx, That percentage used to be massive back, 2-3 decades ago, and it's been in a secular decline as well. In other words, they're not reinvesting their capital into new mines, new projects. We haven't seen new projects in a very long time come online and become large producing assets. That is a huge part of the problem. The other thing we haven't seen either is discoveries. We all know that discoveries have been of new gold discoveries and silver discoveries too, or even copper, if you want to go to the base metal space, is a problem. I mean, we're not seeing any major amount of ounces being added to global reserves. And one of the things that I think is very important, which is going to be my letter, is going to be all about this really, is a signal that I started to notice more recently, which is most of the major companies in the gold space are actually almost like moving away from gold, sounds like. I mean, you see the global or the gold production for the major companies are all in a secular decline. I mean, look at Barrick, for instance. Barrick has been in a secular decline. Look at Goldfields. Look at Anglo Gold, Kinross. And in Newmont's gold production is back to where it was 15 years ago. Okay. So what's happening is production is declining. It has started to decline. Global production, since the majors really make up about 1/3 of global production of gold. So there's a lot of alluvial mining that actually still is a huge part of gold production. But even including that, on a worldwide kind of stage, you can see that gold production started to decline for the first time in 2020. And I think this is the beginning of a trend, not the end of one. And we've seen this before. If you go back to the 70s, there were two gold bull markets, one in the early 70s all the way to the end of the 70s, and the other one in the early 2000s and all the way to 2011. Those two had different drivers for gold prices. One, we had inflation. The other, we didn't see the same level of secular inflation. Both of them kind of had, this CapEx issue more severe, I would say, in the 70s than in early 2000s. So they kind of had different drivers really impacting gold prices to move higher. But the one thing that was the same was that gold production declined secularly during both times. In the 70s was an 18% decline. And then in early 2000s to the late of the bull market at that time was an 11% decline. And so that declining production is very much aligned with the shrinkage of supply overall on top of, or the supply is staying constrained at a time when the demand is increasing. And if there was ever a time for us to be making the case on the demand side for gold, that is today. Well, when we have a deglobalized environment, we got central banks having to improve the quality of their reserves, having to sell treasuries, either because they have to manipulate their currency higher, or because simply they don't want to be holding treasuries anymore. So they're having to buy gold. So we're seeing central bank purchases increase. And on top of it, we have the failing 60-40 portfolios. That is a huge deal. I mean, that just means portfolios are going to go back to holding something else that is defensive, that creates that haven aspect to portfolios as a whole. And the only thing I can think of that can replace treasuries is not crypto. It's actually gold. It has got a pristine track record of being that defensive asset over time. And I highly doubt that it's not going to be the case again. And then on top of it, you look at the gold to silver ratio being where it is. It makes you even think about, wow, then what does it mean to silver? It's even, it's mind blowing. So to me, this is the perfect storm of what's happening. Sorry for my long answer, but that's really what's in my mind. And finally, just to make one point, is that we've declined, major companies in the gold space have declined their reserves by about 33%. So if they're not finding new reserves, their existing reserves are being depleted. 33% since 2007 has been mined over the last years. And then you look at the existing reserves today, the quality of that is deteriorating. The average grade is also in a secular decline. We haven't found not only new discoveries, but discovery or the quality of it is just actually deteriorating over time. So I think this is mind-blowing. It has to do with the ESG policies, where a lot of those companies are being forced to move away from gold into copper, into critical metals. And, to me, this is a paradigm shift for the gold industry in general. And perversely, just like oil, while everyone is running away from it, I think it's going to turn out to be the time to be investing in it.
Right. So that was a perfect segue, Tavi, into the next chart I have from you. And it was talking about cash flows versus acquisitions. And to the extent that, new exploration's not occurring, we know that investment is really less than half of what it was, say, in 2011 with the junior miners. And there's not a lot of merger and acquisition activity, as well as your point that the gold miners aren't even investing in their own projects. It seems as though there's been a move of this money into other aspects like base metals, and like you said, some share buybacks and things. At what point, with that coming gold cliff, does this become an issue that we haven't, that the industry is not healthily acquiring new ounces, and further that some of these projects that the juniors have been trying to work on aren't getting attention for the majors so that they can get funded? What does that mean really for the industry itself?
The main reason for it is well, there's a lot of things, right? I was in a dinner with a bunch of geologists. It calls my attention when I see experts in this industry actually becoming bearish in the space. And that to me is just how telling it is about where we are. And I had one of the geologists, I'm not going to say names here, and he asked a question in the table. And the question was, what is the moral reason to be mining gold in the first place if it's not used to function the global economy? Okay, that's a fair question. But the answer for it is that, first of all, it is used to function the global economy, but it's not a large part of the demand for gold. It's between 12 to 15% used in technology and electronics. I understand it's not a huge part of it. So why even mine gold if it's not used in the global economy in a large way like copper is, or even energy actually is separate from mining? But so what's the reason? And the reason really is, look, gold, there's the perfect answer for that, in my opinion, is all the properties and the industrial broad range of things that gold does in separate ways is what makes this one of the most valuable commodities in the world. And the lack of or the natural scarcity of the actual commodity is what makes it so valuable as well. And on top of it, what you have is the reasons for the natural supply constraints of it, and how difficult it is to mine or to find gold in general. On top of it's as I said, the broad range of uses that can be for any economy, any time, is what makes it a perfect place to be used in the monetary system, and why we've seen it being used in the monetary system for so many centuries. And so, right at a time when we've had this kind of 40, 50 years of monetary lack of the monetary discipline, I don't blame the younger generations for not understanding the history of gold and not appreciating the value of the metal today. I mean, think about it. We've had 30 years of a prosperous time of no, real issues geopolitically speaking. We've had, this a prosperous time as well in terms of appreciating the fact that we had cheap labor to take advantage of, and for many, many years. Everything has been cheap to produce. Companies have been going to China and taking cheap labor, even borderline of slavery, or call it slavery, whatever it is. And so we've had that for many, many decades now. And I think a lot of folks have appreciated from that and don't appreciate the fact that we also have had decades of cheap money and more units of debt for less units of growth over time. And at some point, we all know that that's unsustainable. And so now we're starting to see that was the whole reason why we had the crypto industry emerging, right? I mean, the crypto industry only emerged because of that, because of the folks beginning to question and use even the gold thesis of all the problems are going to be resolved in some sort of new currency, and questioning fiat currencies. What are they backed by, and so forth. Well, those same questions, now we have the crypto market completely collapsing for its own reasons, especially related to the frothiness of the market in general. And we still have people questioning gold itself. I mean, even Wall Street Journal put out a freaking right on the front page saying the gold lost its reserve status. I mean, you can't make this up anymore. It's just a list of things going on. It's major companies don't want to mine gold. Is investors questioning why gold and what's the moral reasons to be invest in the space? Is geoscience folks the enrollment of those in a secular decline trend as well? The list of reasons to own the metal have never been so strong right now, and I never thought it would be such a contrarian take. Right now, and it is. I mean, it is as contrarian as it gets to be such a bull in the gold space. And so most of institutional capital is chasing the base metals because it makes sense. They want to buy the critical metals for the green revolution and the electrification and so forth. They think gold is not going to play a role there. I completely disagree. Not that gold will play a role into electrification as much as copper, but my goodness, what about what's going on with this madness of expansion of monetary base and indebtedness that we've seen so far? Where are we going to go from here? And so it's going to have to play a role. It will play a role. And on top of it, the 60-40 portfolios is just adding to that issue in terms of portfolio positioning. It's like I said, it's the perfect storm for precious metals in general. So it is, it is a problem for the overall industry. I think you look at that chart that you're showing, it was basically showing the level of cash flow is still near record levels for most of the major companies at a time when we haven't seen much of the heating in terms of the M&A cycle. M&A cycle is one of the most important things you should look at in terms of the cycle of mining as a whole. Companies tend to go on a buying spree right at the peak of the cycle, and they also tend to be extreme conservative in the bottom of the cycle. So we're definitely at a bottom, in my opinion, and it's as clear as it gets. And so, it's time to be allocating capital on something that, it does have the history that other people are not. I think a lot of young generations are going to learn a very valuable lesson of history here in the next 10 years. And I think the sentiment will shift drastically over time as we see things moving. And in the 70s was similar, but not exactly the same way. The reasons were not ESG and electrification and so forth, but gold production was falling back then as well. And the whole situation there actually created or unleashed a 15-year of new discoveries and production increase. And that's really what caused gold prices to drop in the following decade after the 70s. Outside of inflation itself, there was a huge amount of supply that came into the space in the next 15 years or so. Some of the biggest discoveries we made was in between the 80s and the mid to late 90s. And so that's really what caused gold prices to fall apart as well. And I don't think we're going there right now.
All right. Lots of good information on that market. What's your call for gold and silver for 2023, Tavi?
Prices? I mean, I have no idea where prices are going to be. I think the direction is higher. But look, I think it's very it wouldn't surprise me if we're around 23 to 2,500. Wouldn't surprise me at all. I think it's very possible. If you were of the view that we're going to get, which is my view, a decade where gold prices are going to be higher, not lower. It's been my opinion where, and I kind of had that view back in 2018 or 2019 or so, which was also the same point. It was like, well, if gold prices are going to be higher, how do I maximize and how do I really capitalize on this? Because gold prices, yeah, they go higher, but it's not really where you make those kind of generational wealth types of returns. And so what makes me think of, immediately you think about, other things like silver, and silver is another way to find allocation there. I think silver could easily be trading at $30, $35 an ounce next year. I think that's also, if on the back of a gold market going to those levels I just said, I think, yeah, silver could be there as well. But really what attract me to the exploration stage is that the majority of the billionaires in this industry made their money in exploration. They found new discoveries. And today, those business models of they're looking for those discoveries today are historically cheap because of a gold market that is just out of favor. And so to me, that's really where the opportunity lies ahead. If you're really looking for those massive returns, I think that's, in my opinion, that's really where it's going to be driven by. It's going to be mostly in this riskier parts of the market. It is what it is. Bigger risk, bigger returns. So, but the inefficiencies there are present, and I think it's an incredible opportunity.
All right, Tavi, thanks for joining the program. We appreciate having you on Inside the Markets, and we'll speak to you again.
Thanks for having me.